We've got Mr. Keki Mistry, the Vice Chairman and CEO of HDFC, who is now joining in live. Mr. Mistry, pleasure to have you with us this morning on ET Now. Let's just talk about, you're close to launching another dual rate scheme, which is pretty similar to ICICI Bank scheme. If you could just tell us if there has been any progress on that front and what the update is on the same.
We are not launching anything which is similar to ICICI or similar to anyone else. I don't think anyone has ever said that. We are looking at a spate of products and we have to decide which product makes the most amount of sense. We've not decided on anything at the moment.
Mr. Mistry, just let's focus on the current environment, the interest rate environment at this point in time. What is your sense as to when the interest rates are likely to peak out, and what is the expectation from the RBI, keeping in mind that we're still ahead of inflation, above that comfort area for the government?
Yeah, I'll tell you. My sense is that we are nearing the peak of the interest rate cycle, though we may not actually be at the peak. I expect one, maybe two interest rate hikes to happen from now. My best guess is that you will see a 0.25% hike in September, possibly followed by a 0.25% hike in October, and that will be probably a stop after that. And I also believe that once you start seeing inflation numbers get down to around 7-ish levels, which I think will happen when you get to January, you could at some point of time in that January to March period again start seeing interest rates come off a little bit.
Are you seeing the impact on, demand for loans, keeping in mind how high the interest rates are currently?
Yeah, if you look at the last, I know interest rates are high, but if you look at the last 10 years, this is not the first time that we've gone through a cycle where interest rates have gone so high. We have seen this kind of high interest rates a couple of times, or probably more than a couple of times in the past also. And our experience is that there is a relatively much lesser correlation between interest rates and demand for housing loans. And the reason is that the kind of customers that we have are end users, people who are buying a house because they need a house to stay in. They are not investors, they are not speculators. And if someone needs a house to stay in, he's not going to not buy the house just because interest rates are 0.5% higher or lower. Today you take a floating rate loan, so whenever interest rates come down, you will get the benefit of falling rates at that time. And you must also remember that a housing loan, unlike a consumer loan or unlike a vehicle loan, is a long-term loan. So when you take a loan which is for 12 or 13 years, you probably will have to go through 1 or 2 or 3 interest rate cycles.
So what has current loan book growth been at HDFC, and there is no demand slackening that you are seeing?
Yeah. If you see the period up to June, which are now public numbers, the growth that we saw in approvals was 22%. The growth that we saw in disbursements was 20%. The growth that we saw in the loan book was also 22%. And our target has always been around 20%. We continue to believe that around the 20% growth is what we should be seeing for the full year. July has also been a good month, and August so far has also been a reasonably good month.
Mr. Mistry, given the current...
But there obviously, sorry.
Right, go ahead, sir.
Yeah, there are pockets in the country where it's slow. Like, for example, Mumbai is slow. But if we leave out Mumbai and possibly 1 or 2 other places, in most of the other cities, most of the other towns, the growth continues to remain fairly good.
Right. Mr. Mistry, just wanted to get in the sense of the current economic environment that we're working with. You said interest rates are close to peaking out given the high inflation. What is your view on the economic growth for this fiscal?
If you're looking at GDP growth, my expectation is that we should be looking at upwards of 7.5%. Whether it is 7.5 or 7.7 is really a matter of detail, but it should be somewhere in the 7.5 to 7.7, 7.8% range. See, what is the good part of the global slowdown and the global problems is also that commodity prices start softening at a time like this. We have seen oil come down from $120 a barrel levels to 107, 108. And if this kind of a situation continues in the West, it is quite likely that over the next 2 or 3 months, we should look at oil coming down below $100 a barrel. And with India being such a large importer of oil, it would have some impact both on our fiscal position as well as on inflation.
Mr. Mistry, what is the outlook on the spreads given the current interest rate environment? And also, if you could, let us know, is there any postponement from borrowers to, come ahead and apply for these kind of loans?
See, postponement would be more in terms of property prices. So if the perception is that property prices are high and are therefore unaffordable, then people postpone the decision to buy. Now, affordability is measured much more in terms of property prices than in terms of interest rates, because interest rates is a long-term thing. So rates will go up, rates will come down. But property prices is more relevant, and that is probably the reason why Bombay has seen, or Mumbai has seen, a fair bit of slowdown over the last couple of years with property prices rising so much. But when we look at this on a pan-India basis, we see that the cost of a house as a multiple of the income of our borrowers is around 4.7, 4.8 times, which is pretty much in line with what it has been over the last decade. You asked me about spreads. Now, we have a completely matched balance sheet. We take no mismatch in our funding. We give borrowers both fixed rate loans and floating rate loans. Whatever loans we give on a fixed rate basis, we fund it out of matching term fixed rate liabilities. Whatever loans we give on a floating rate basis, we fund it out of floating rate liabilities. And therefore, irrespective of whether interest rates are high or low, our spreads tend to be reasonably stable. We operate with spreads which have ranged between 2.15% to 2.35%. And you see the last 10 years, you will see that spreads have always been in that range. And I continue to believe that spreads would remain in the same range in this environment also.